Today on Go Ahead Ask, the House Ways and Means Committee has proposed changes that will likely and significantly impact your self-directed IRAs and self-directed individual 401k plans. Let's unravel that mystery today on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate to provide investors with better quality educational information so they can make better informed investment decisions. I'm Bill Exeter, Chief Executive Officer of Exeter Trust Company, and your host today. The Exeter Group of Companies includes Exeter 1031 Exchange Services that acts as a qualified intermediary or accommodator for all types of 1031 exchanges in all 50 states. Exeter Trust Company serves as custodian for self-directed IRAs and self-directed individual 401ks, as escrow agent for specialty holding escrows, as trustee for title holding trust or land trust, and as custodian for specialty custody services. As always here on Go Ahead Ask, we encourage questions, we encourage topics, or even if you want to appear as a speaker, contact us by calling us at area code 619-239-3091. Again, that is 619-239-3091, or you can email us at ask@exeterco.com. Again, that's ask@exeterco.com. And if you love Go Ahead Ask, please like it, subscribe to it, share it, and comment on it. We will respond to all comments that are posted. Today, our topic is unraveling the mystery of proposed tax policy changes that will affect self-directed IRAs and individual 401k plans. You know, we've talked about this before, where retirement account investors have been able to use their self-directed IRAs or their self-directed individual 401k plans to invest in what a lot of people call non-traditional assets, or sometimes they're referred to as alternative assets. And they've been able to do this for years. This includes assets like real estate, deeds of trust, mortgages, tax lien certificates, LLCs, partnerships, and more. But this current regulation or proposed tax policy change is going to change a lot of that in certain situations. The Build Back Better Act, which has been advanced by the House Ways and Means Committee last week, is going to have a significant impact on your self-directed IRA and your individual 401k plan, especially if you're working with investments that require you to be accredited investor status. We're going to unravel that mystery today on Go Ahead Ask. So diving down, first, we've talked about self-directed IRAs a number of times, obviously because we're a custodian of self-directed IRAs. So for those who want to go back and cover, say, the basics of self-directed IRAs, or what they can invest in, or how you can actually buy real estate and real estate related assets inside of the self-directed retirement account, go back and visit episode 10, which is the basics on self-directed IRAs and individual 401k plans, or you can go to episode 16. That covers kind of buying notes, promissory notes, and other types of notes, or what they call paper, inside of self-directed IRAs or individual 401k plans. And our episode 23 went into more detail on how exactly do you buy real estate inside of the self-directed retirement account, including ways of making offers, completing purchase and sale agreements, etc. But today we're going to focus on the proposed tax policy changes that are coming out of the House Ways and Means Committee markup that was released last week. So first, where does this come from? Why is this coming out today? Well, if you go back to a number of presidential elections in the past, we've had a lot of press and focus on the Mitt Romney self-directed IRA. And at that point, it was being touted as $102 million self-directed IRA. More recently, you have Peter Thiel's $5 billion self-directed IRA, which, of course, he's the founder of PayPal. And so these are perceived abuses, but they're not. These are not abuses. This boils down to someone who's got an idea, who wants to start a business, takes their self-directed IRA, invest a couple $100,000 or whatever they have, usually it's their life savings, to start up a business. And they're risking this money, they're risking this capital. And if the business fails, and odds are that it's more likely to fail than to succeed, they lose all of that money, all of that hard-earned savings that they've worked to build up. But occasionally you get somebody who does the right thing, makes the right decision, has probably luck on his side, and succeeds. And if they bought that stock to start the company in their self-directed IRA and they succeed, think about the fact that they have started a company. It now creates thousands of jobs for other people. It creates income. They pay taxes on that. And yes, their self-directed IRA benefited from that because they were successful. Why should they be penalized for that? And that's what it boils down to today. So we wanted to cover this in our podcast to discuss the changes that are coming up, and then we're going to start with some of the basics and then end with the two that I think are the most detrimental. So first, the Build Back Better Act. It's been advanced by the House Ways and Means Committee. It's going to significantly impact self-directed retirement accounts in a number of different ways. So we're going to cover each one of those, but it's really going to hit those who are involved in the alternative investments or non-traditional assets. So anyways, among other changes, it's going to have a number of things. The first one is it's going to require a minimum distribution, excuse me, if you're self-directed traditional IRA or your Roth IRA or even a defined contribution plan together has a balance in excess of $10 million at the end of the prior year. So if you start a business, you invest in some private equities, you're very, very successful and it builds up to a balance in excess of $10 million at the end of last year, there's going to be a new minimum distribution required where you'll have to pay tax on that the following year. The proposal now seems to be a 50% tax or 50% distribution, I should say, of anything in excess of $10 million. Why? We should be rewarding people to start businesses, to build businesses, to create jobs, and not penalizing them for success there. The next one is they're going to prohibit further contributions to a traditional IRA or a Roth IRA under the same guidelines. If your retirement account balances exceed $10 million at the end of the prior year, you no longer qualify to make a contribution to your retirement accounts if your adjusted gross income exceeds certain limits. It's going to eliminate Roth conversions, so you can't convert a traditional IRA to a Roth IRA. For single taxpayers or even married taxpayers, if you have taxable income over $400,000 for married taxpayers, $450,000 if it's joint, heads of household with taxable income over $425,000, all indexed for inflation. It's going to also expand or lengthen, I guess is a better term, the statute of limitations. So currently, if there's a prohibited transaction, they can only go back 3 years and audit under that statute of limitations. They're going to double that to 6 years. And obviously that's to help the IRS pursue those who violate the various prohibited transaction guidelines and what have you. They're also going to tighten up the rules on investing in an entity where the IRA owner has an interest. It was if you had an interest greater than 50%, now it's going to be dropped down to greater than 10%. We're going to take a quick message from our sponsor. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8800. 8750 or visit them on the internet at exetertrustcompany.net. And we're back at Go Ahead Ask Podcast. And let's get back to unraveling the mystery of the proposed tax policy changes affecting self-directed IRAs and individual 401k plans. These next 3 points are really the ones that concern me the most. They are focused on the self-directed IRA and the alternative investments that many people get involved with. And again, it goes back to the Mitt Romney IRAs, the Jeff Thiel IRAs, and those type of accounts. Very, very few. I mean, like it's probably 0.001% of IRAs out there have any type of major balances like that. The vast majority of our clients, roll over and invest maybe $25,000, $50,000, $100,000 in these type of securities that they're going after here. So the 3 things that concern me the most, it's going to prevent an IRA owner from investing in an entity in which the IRA owner is an officer. That's going to have significant impact, especially on those investors who've set up what they call checkbook IRAs, where the self-directed IRA or the self-directed 401k plan sets up or forms a limited liability company inside of the retirement account as an asset. The self-directed retirement account funds or capitalizes that limited liability company, and the individual is the manager of that limited liability company and then goes out and makes decisions and invests the money through the LLC. The way this is worded, it looks like it's going to eliminate the ability to do that type of an investment transaction. Second, they're talking about prohibiting an IRA from holding any type of a security or an asset if the issuer, or also called the sponsor of the security, requires the IRA owner, the account holder, the taxpayer, to have certain minimum levels of assets, of income, or have completed a minimum level of education, or has to have some type of specific or special license or credential. And the third one, which kind of goes hand in hand, is they're going to prohibit IRAs from holding investments which are offered to what they call accredited investors. So these are people, again, who have some type of minimum net worth, and they're going to limit it to those folks if the requirement for that particular investment is to become or must be an accredited investor. Now, why would they do that? I mean, this is a method for a lot of small businesses, startup businesses, to raise capital, to start a company, create jobs, stimulate the economy by raising capital through self-directed IRAs. If we eliminate the ability to invest in different types of investments just because you're required to be an accredited investor, we have eliminated a huge source of capital here. And again, most of the investors that do this put in $25,000 or $50,000 or $100,000. We're not talking about multi-million-dollar investments. So those are the 3 changes that concern me the most. But to add to that, if you currently hold an investment that is considered or requires an accredited investor status, then you have a 2-year window once this bill passes to actually liquidate the investment, which means have the self-directed IRA sell that investment and get rid of it. Or if you can't liquidate it, or if you do, you're probably going to take a significant discount. People are going to know there's a 2-year window. They're going to know you have to get out. A lot of people don't want to buy non-liquid assets. So you're going to have to sell this at a discount. If you can't, then you're probably going to be forced to take a premature distribution and distribute the asset out of your self-directed IRA. And then you get hit with taxes and penalties and whatnot. So why would they do this? That is the question. So these are the 3 things we are most concerned about, is limiting the ability to do the checkbook IRA, limiting the ability to invest in securities that require an accredited investor status, or if you already own that security, that you'd have to divest yourself of that asset within that 2-year window after this bill may pass. Obviously, this can change. This is in bill format. There's going to be a lot of lobbying and negotiations going on here. So stay tuned. This could change. They're probably going to tweak this. Hopefully they throw this out of the bill, because this is just bad legislation. It's going to hurt a lot of investors. It's going to hurt a lot of people who might otherwise start up a business and need to, capitalize the business by using self-directed IRAs. So let's keep an eye on this. Stay tuned. It will help get information out to you on how you can reach out to your representatives. Today, if you can reach out to your senators, your House of Representatives, let them know you disagree with this, you oppose this. This is bad legislation. It's going to hurt the economy. It hurts small businesses. It hurts the ability to start up small businesses. They just need to throw this out of the bill. But we'll follow up with more additional information later. So with that, thank you again for listening to today's podcast. We're glad you can join us. Hope you can reach out and help us fight this fight. As always, on Go Ahead Ask, send topics or questions to ask@exeterco.com, or you can call us at 619-239-3091. Again, that's 619-239-3091. If you love our podcast, please like it, share it, subscribe to it, and comment on it, and we will respond to all of your comments. Thanks for joining us again. Have a great day.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.